Hello, good afternoon, happy Thursday. Hope everybody is having a good day. And we have quite a bit to cover, of course, with the Fed right back in focus after a little bit of a shorter week in trading here with the markets closed on Monday. We're going to talk again about the Fed, but we're also going to share a little bit about some jobless claims and how that impacts things. And then a great question of the week about what to do during these summer months, what is typically a little bit lighter volume in trading and how to kind of look into things during this period of let's say June to September. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a lot of this noise, especially lately along the way. So again, we'll kind of get right into it. And again, this week was a little bit shorter as far as trading goes with the holiday Monday, but certainly no lack of data and trends to watch this week by any means. The biggest focus, yet again, we've covered it all last week. We covered it this weekend with a special brunch with Brandon around the Fed, is exactly that. It's the Fed, it's the interest rate path, and it's Fed Chair Powell. And here we are again this week talking about it yet again, because Fed Chair Powell has been testifying in front of the House and the Senate here both Wednesday and this morning on Thursday. And, the gist of it is that we kind of shared our take last week on what's going on with the Fed. So I don't want to beat that up too much. But here we go. We fast forward into this Wednesday and Thursday. And the reality is that the Fed is really, or Fed Chair Powell, I should say, is very clear that they are not done and they're not going to pull back until they have tamed inflation, which has not happened. But yet, we see on Thursday last week after the Fed, and then really to some degree this week as well, the market's kind of calling his bluff. Is the reality. I think that the markets are showing that they don't really believe what the Fed is selling. And I think that's a dangerous game to play because the Fed has been very clear in the past of their path and what they're going to do. I don't know that it's really any different this time. So we will see. Don't get me wrong. He has shared time and time again that the data will determine the next move. But within that, the context within the conversation is very clear that they expect that they're going to continue to have to hike rates, and they will do whatever it takes to get inflation back down. This week's been a little bit different with, Wednesday, the markets pulled back a little bit after the testimony, but nonetheless, it's nothing like what we would expect if the markets believed that the Fed was going to hike coming up in this July meeting. The markets have priced in basically a complete pause, and the Fed is saying we're not done, and there's a big discrepancy between the two. So obviously, it remains to be seen what they will do next month, but something to really pay close attention to. And again, a bit of a dangerous game to play to say they're done if they're really not. So just something to watch really closely here. And a little bit of a tip of the cards, but next week we get some inflation data that will start to reiterate what's going on here. Before we get to that, though, today on Thursday, we also had initial jobless claims come out, and initial jobless claims did tick up slightly to about 264,000. So again, certainly a tick up, but I don't know that this is going to be weighted too much in terms of the Fed path and all this interest rate decision and rate hiking conversation, because there's such a big discrepancy in job openings, right? If even if this continues, there's such a big gap that it's going to take some time, I think, to get to a place where the Fed would be concerned about the labor market. Now, that said, in the testimonies, he has shared a little bit to this tune, kind of watching this labor market and seeing what that looks like. But again, it could happen. It could be drastic, but I expect that it's going to take some time before the labor market really factors into these conversations. Before we get to our great question of the week, I want to just touch briefly on what to expect next week. Next week we have home sales, we have consumer confidence, and jobs, of course, but this is all ahead of inflation data starting to pour in. So next Friday, we start to get some inflation data moving into the following Wednesday. So I guess I'd love to hear your take. I'm curious your take, like where you think inflation may fall here as we get to that point. Do you think that inflation is going to be in line with expectations? Do you think inflation may surprise on the high side? Let us know what you're thinking, because this is going to be obviously a big point of a big point to emphasize and to follow as we get closer and closer to that Fed meeting in July. And again, the last inflation data point certainly showed that core inflation is still running pretty high. So that'll be a big focus here coming up next week. Before we break for the day, I do want to address a great question of the week from Andrew. So Andrew, thank you so much for sending this in. And it's kind of twofold. It's basically with these slower summer months, the reality is typically from Memorial Day to Labor Day, the market is a little slower. That doesn't mean down. It just means that there's less trading volume, less shares moving, less people trading. And so the question is what to do during these months, but also how we factor in all the volatility we've seen lately from the Fed decision and what's going on with interest rates. And I think first off, I want to put in perspective, we always want to focus on the long term. So don't get me wrong here. As I share this, it's not to completely revamp things, right? We need to make sure we're always focused on where we're going and what we're trying to accomplish with our portfolios. But some tweaks along the way can certainly give you some opportunities and help manage risk. And I think a great thing to think about is where we stand with interest rates today, right? So looking back the last 3 years or so, we've been very cautious around bonds because as interest rates rise, bond prices actually fall. And so for those who have held bonds the last 2 years, you know what this means. You felt it in your portfolios. And it's something that was very clear was going to happen. So we tried to reduce that as much as possible. We shortened the bonds basically to cash equivalents and took a lot of that volatility out of the mix. Now, on the flip side, here we are, June of 2023, and now interest rates are up near 4 or 5, sometimes even 6% on cash and bond type of instruments. And so it's much more exciting to look at these opportunities, right? The Fed rate is 5%. So, that is a pretty attractive yield compared to what we're used to the last, 10, 15 years. So there's maybe two considerations with this. Number one is consider cash, and I don't mean cash, but something that produces something around that, that yield that can hedge a little bit against any sort of volatility, especially if the Fed does surprise us, or I should say surprise the market, or the market is wrong and calling out their bluff. So that's one thing to consider. Now, if you lock that in too long, obviously the challenge is if the markets rebound, you're kind of stuck with this opportunity cost dilemma, which we covered actually the definition of that a couple of weeks ago in a video. So check that out if you have a chance. But part two is to also start exploring bonds again. And really where I'm going with this is it's not to say this is like where you need to go with everything, but before, where bonds were something we were really trying to stay away, now it's something we're starting to look into and start to slowly chip into, because if bonds are paying, let's just round down even, and let's just say 4% yield, right? Paying a 4% clip just to hold them, that is all well and good first off. But second off, if rates actually come down, just like when they come up, bond prices fall. When rates come down, bond prices increase. And so bonds can be a great place to start looking into at this point. You may want to kind of pick your timing a little bit on that to try and make sure that you're getting the most out of it. And really what I would say is don't do it all at once by any means, because who knows where rates could go in the short term. I also think that it is going to be a little longer than a lot think before rates do come down, before the Fed starts cutting rates. But if that happens, bond prices appreciate. And so you're getting a great clip for potentially some appreciation as well if rates do go down. So again, this is not to throw away the long-term plan by any means. It's just more that before bonds were very difficult to say that there was any opportunity. Now we're starting to see that opportunity. And so starting to explore that could be helpful, especially during these potentially slower summer months, but potentially volatile summer months as the Fed, comes to another decision there in July. So thank you so much, Andrew, for sending that in. That's a really good question for today. Hopefully this is helpful, and definitely tune in next week where we will cover some of the inflation data and start to get a little bit of a glimpse of what's ahead here. Have a great upcoming weekend. It's supposed to be very nice here in the Pacific Northwest. So enjoy the sunshine, and we will see you next Thursday at 3.